Ladies and gentlemen, good day and welcome to the Q1 FY26 earnings conference call of Yasho Industries Limited, organized by MUFG IR. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the call over to Ms. Masoom Rateria from MUFG. Thank you, and over to you, Ms. Masoom.
Thank you. Welcome to Yasho Industries Q1 FY26 business call. Today, we have with us from the management, Mr. Parag Jhaveri, the Managing Director and CEO, along with Mr. Chirag Shah, the CFO. Before we proceed with the call, I would like to give a small disclaimer that the call may contain certain forward-looking statements which are based on the business opinions and expectations of the company as on today. A detailed disclaimer has been given in the company's investor presentation, which was uploaded on the stock exchange. Now, I would like to hand over the call to Mr. Parag Jhaveri. Over to you, sir.
Good afternoon, and thank you everyone for joining us for today's results call for the quarter ended 30th June 2025. We truly value your continued support and interest in Yasho Industries' performance. As we discuss our financial and operational performance for Q1 FY26, I would like to emphasize our unwavering commitment to maximizing value for our stakeholders. We began this financial year on a strong note, delivering the highest ever quarterly revenue of our company at 198.6 crore. This marks a 14% year-on-year growth achieved despite a challenging global macroeconomic environment. What's even more encouraging is the 33% growth in volumes, underscoring the robustness of our operation and continued trust of our customers. Segment-wise contribution, industrial chemical represented 87% of total revenue, while consumer chemicals accounted for 13%. This volume-led growth reflects not just robust market demand, but also our ability to deliver value consistently. Even in a weak pricing environment, it reinforces our strategic choice, being the capacity planning, customer engagement, or product positioning, and set a strong foundation for the rest of the year. While the pricing environment remains subdued due to correction over the past year, we are now seeing clear sign of a price stabilization, which bodes well for the coming quarters. Our conscious effort towards product mix optimization have yielded results, enabling us to maintain healthy EBITDA margin of 18.01 on a standalone basis and 17.05 on a consolidated basis. From an operational perspective, our Pakhajan operated at over 50% utilization during the quarter. We are actively working to enhance utilization level through deeper customer engagement and potential collaboration with global partners. We expect those efforts to bear fruit in the coming quarters, further supporting our growth trajectory. Externally, the chemical industry is currently navigating a phase of policy uncertainty, particularly on tariff and trade, leading to temporary delay in order finalization, particularly in industrial and auto ancillary segments. However, we believe this disruption is short-term in nature, and we anticipate greater clarity in the months ahead. Importantly, demand across our core chemical portfolio remains steady, and we are consistently gaining market share even in these uncertain times. On the CapEx and R&D front, we have already incurred rupees 30 crores of our planned annual CapEx of rupees 100 crore. Our state-of-the-art R&D laboratory, a key pillar of our innovation roadmap, is progressing as scheduled and is slated for completion by October 25. This facility will strengthen our product development capability and position us well for the future opportunity in performance chemicals. On the financial front, our endeavor is to improve our ROCE and debt to EBITDA ratio by following initiatives. We try to improve the asset turn by better capacity utilization, and 2, further reduction in net working capital from 190 days to below 150 days, primarily by optimizing raw material and the finished goods inventory. This will help us to improve our cash flow also. Backed by strong order visibility, a growing customer base, and continued operational ramp-up, we remain confident of delivering over 40% revenue growth in FY26, while staying firmly committed to sustainable value creation for all our stakeholders. In closing, I want to thank our employees, customers, partners, and you, our valued investor, for your continued support and belief in our journey. We remain focused, resilient, and optimistic about the future. Thank you again for your continued support and trust in Yasho Industries. We are now happy to take any questions you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Parth Agarwal from Bastion Research. Please go ahead.
Hi, thank you for the opportunity. I have just one question regarding our gross margin. So our margins peaked out in September and December quarters, which was around 45%, and we turned it down to 40%. Can you just share us some insight on this particular happening, and where do you expect this to stabilize?
Well, our guidance for this margin is always in the range of 38 to 40% only. That was one of the exceptional quarter we had with a couple of our key performance chemicals had a demand, and those are only once in a year demand, so that can happen in any one of the given quarter. But our general guidance for raw material to the finished goods consumption is in the range of 40%, plus minus 1%, 2% here and there.
Got it. Okay, thank you so much.
Thank you.
Thank you. The next question is from the line of Ashutosh Nemani from JM Financial. Please go ahead.
Yeah, hello sir. My first question is regarding our margins segment-wise. Can you please give the margin for industrial chemicals and consumer chemicals both for Q1 FY26 and year-on-year comparison as compared to Q1 FY25?
Well, as long as consumers consider our margins in a single digit on EBITDA side, okay, while in an industrial it is much more than 20%, so the aggregate margin comes to in the range of about 17 to 19%, and we believe that we will be able to hold on for FY26 also the same guideline.
Understood. And sir, second question is regarding I'm new to the company, so I just want to understand the pricing decline that has happened in this quarter. So structurally, what has been in what products has been there been a pricing decline, and do you expect it to be stabilized? And can you please elaborate? Was there a more supply capacity addition, or there was a demand problem that led to pricing decline? Just want to understand it.
Yeah, well, see, we have already mentioned that in our industrial segment, some auto ancillary and automobile, we see a lot of pressure, and that industry is going through a little bit of turmoil. There, our finished goods, to retain the market, what we had, we need to compromise on our margins, and that has dragged us for this particular quarter. We are expecting in the next 2 quarters that should stabilize with a lot of clarity on the policy and the tariff and trades, what we are challenging today. So at least by end of this Q3, we should have a stabilization on that part of it. And we expect the price pressure should ease by that.
Yeah. And sir, I just didn't catch the tariff part. So in case there is an incremental tariff, then would the price be passed on, or how will the dynamics in that case work?
I think Ashutosh, this is just a very recent environment. We are all waiting for our government clarification, and so we don't want to get into it today. We need to review it, where it's going to end actually, the policy statement, and then we'll take a call on it. But yes, that if that don't have resolved, then we may have a challenge, a little bit challenge there, and then we have to talk to our customers that how much we can pass it on and how much we cannot pass it on.
Understood. And so this 40% revenue growth guidance that we are given, is it assuming the pricing levels stay same? Right?
When we are talking yes, I think we talk about 40% guidance is very much with the current market trend only. So we are very confident. Despite recent turmoil in the tariff statement, we are still confident that we will be able to achieve this 40% growth, at least 40% growth.
And the fixed asset turnover that you mentioned that will reach to 3 by FY27. That stays.
I think there is no change in that vision also. We are very much expecting that we should be able to achieve, as we have installed capacity last year, and the current year in a 2 product line we are increasing our capacity also, which is giving us a lot of confidence. And with the current this year capex of about 75 crores in a plant and machinery and 25 crores in R&D. So we are looking at 75 crores, which will give us an additional revenue, but that will happen only in FY27, not in FY26.
Okay, understood. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Manan Shah from Moneybee Investment Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my question was that have you seen corresponding decline in our raw materials as well, along with our end product prices?
Yes, we did see in some of the cases raw material also declined, but more of we see the price competition on our finished goods rather than the raw material. So we see a challenge there because of somewhere there's a slowdown in some part of the world which is causing us that.
Okay. And initially we used to talk of 4 products, product A, B, C, D is how we used to classify in our presentation that we were looking to commission in the Pakhajan plant. So have all 4 products been commissioned, or it's any color on that if you can give?
3 has been commissioned. 4 should commission by end of this year.
Okay. And approvals also we've received for all these 3 products?
Yes, absolutely. Absolutely, we received all the approvals.
Okay. And what is the exposure towards the US market in terms of these new products, or as well as the current products that we have?
Well, currently in Yasho's revenue share, US is about 25% of the revenue.
Okay. And this new product that we are developing, in that also is US a major market, or EU is also equally a large market?
Well, all our product has a market share across the globe, so US will remain only up to 25%, which will not grow share for that.
Okay, sure. Thank you.
Thank you, Manu.
Thank you. The next question is from the line of Darshil Javeri from Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question. Firstly, congratulations on a great set of results, sir. Hopefully, I'm audible.
Your voice is crashing, so can you be a little bit soft or...
Hi. Is this better, sir?
Yes. Thank you.
Yeah. Okay, thanks so much, sir. So, sir, I just wanted to ask, we are saying 40% revenue growth, but in Q1, we've done around 10-11%. So by that logic, the next 3 quarters have to grow more than 50%, I think, roughly. So how do we see that quarter-on-quarter increase in revenue, sir?
I think generally our first quarter little slow, if you look at it in history also. If you look at the FY25 numbers, the quarter-on-quarter our revenue grows, and the third and fourth quarters are very strong quarter for Yasho. That's historically. And we are very, very confident that with this, the capacity and also the more and more customers are buying product, despite slowdown in the market, we are regaining the shares from somebody. It's not the market growth, but it's what we gain the market, more of market. And there we see the good opportunity, and we are still very strongly bullish on that we will be able to achieve that.
Okay, that helps a lot, sir. And sir, when our revenue increases by so much, so we'll have better capacity utilization that will give us an operating leverage. So our EBITDA should also correspondingly increase. Is that a fair estimate, sir?
Yes, but Darshan, currently the geopolitical situation such that we try to hold on our business rather to go for a higher margin. So currently that's not the situation where we say that yes, we'll be able to increase our EBITDA of beyond 19%. So we are giving a range of 17 to 19, and in a worst scenario we are doing 17. On a good scenario, we should do 19-20, but we are not going for 20. We'll say between 17 to 19. We'll be able to maintain our margins on an consolidated level, not on a standalone.
Okay, fair enough, sir. And I just wanted to know what kind of pricing power do we have with our customers in case this 25% margin is there? So how do we see that impact? So tariff is there, then how do we see that impacting us, sir? Will we be able to pass on some prices, or how does it work, sir?
I think we need to wait and watch for over a week or 10 days more to have a lot of clarity on the subject, because there's a lot of confusion is there. There is no official declarations there, so we will wait and watch. We might have more clarity by end of next week, and then we'll start. Couple of customers are very large, so we don't know how they work. Okay, they also export globally back when they consume them, and re-export. So when they are re-exporting that product, they don't have an impact of a tariff, because tariff get nullified there. So it's all depend, It's not that simple, your calculations are.
Okay, fair enough, sir. I just want to know what is our capex outlook for current year, and and what was it last year, sir? How much capex have we done last year?
Last year number I don't have off my head, but I can check and come back to you later on. But this year we are talking about 100 crore capex. 75 crores towards the capacity increase and about 25 crores for the R&D facility.
Okay, great, sir. Yeah, that's it from my side. Sorry, one more question, sir. Our tax rate is what, sir? Because I think last year 30%, and even Q1 we have above 30%. So yeah, can you clarify on a tax rate, sir?
29 point something. So yes. It's come to close to 30%.
Okay, tax rate is around 30%. Okay. Fair enough, sir. Thank you so much, sir.
Thank you.
Yeah.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Manish Gupta from Solidarity. Please go ahead.
Thank you for the opportunity. This 75 crore capacity expansion that we are doing, is my understanding right that this capacity will be available effective 1st April next year?
Yes, sir. We believe that it should be commissioned by January, February, and then trial runs. So actual utilization or the revenue generation will happen from the Q1 of FY27.
Okay. And second question was that based on the March balance sheet, the inventory was quite high.
Yes.
Now, has the inventory reduced over this quarter? And if we are seeing very strong growth, any commentary on what the inventory should be by the end of March this year?
Well, we are looking at March at close to about 150 days. Currently our inventory is down to 190 from more than 200 days. So we are able to down in this quarter 190. As I said in my speech that we will try to bring it controlled by the raw material and the finished goods inventory. We'll try to improve further. Current situation, sometime you don't have a prediction that when the customer put your orders on hold and inventory suddenly increase, it shoots up. But we do have an intention to bring down this to below 150 days. That's our aim, and I think we will be able to achieve that.
But a steady state for the business model, Parag Bhai, if we have 150 days inventory, will we be able to generate an attractive return on capital?
So 150 is also a little high. Good inventory should be the 110 to 120 days, but we need to bring it back. We are growing. We need to hold inventory. Currently, the customers are asking material on call. They don't give you the longer lead time. So because of that, we need to carry unusually high inventory, and we hope the situation change sooner.
Switching gears, Parag Bhai, you mentioned that you are gaining market share. So you're gaining market share from which geography right now?
I think we are growing very much into the export market, and it's coming from the Western world. And I can say that much. I cannot give a pinpoint answer of that from particular what geography, but it is growing in the Western world.
Okay. Okay. Thank you, Parag Bhai.
Manish Bhai.
Thank you. The next question is from the line of Karan from Keynote Capitals. Please go ahead.
Hi. Thank you for the opportunity. So I have one question, which is on we were expecting our customer approvals in Q1. So did we get those approvals, or are they pushed down the year?
I think that must have come. That's why they started buying this product. So we are assuming, we don't get that answer, but we started getting a business from them. So we are presuming that they must have received all the necessary approval from their customer.
Okay, understood. And sir, what will be our revenue per kg currently?
It's below, on a aggregate level, about 400 rupees a kilo.
Okay, thank you. These are all my questions.
Thank you.
Thank you. The next question is from the line of Anup Agarwal from Lucky Investments. Please go ahead.
Yeah, hi. Thank you for taking my question. Sir, my first question is, can you call out your gross debt as of June?
1 second, I can give that. Chirag, I can just give me help me with gross debt.
If you can break it between long-term and working capital, please.
Sure. 1 second, I can get to that data. Long-term debt is about 280 crores and short-term is about 100 crores.
Have we repaid debt, sir, in this quarter? Because our debt was 550 crores closing March.
Total.
Yes.
Yeah, we have repaid some debt also current year, in our current quarter.
What's our repayment schedule, sir? FY26, how much debt are we going to repay?
Well, we have already repaid some debt, so only our repayment will start by November 25 for balance thing. About 9 crore rupees we have to repay.
Starting November, we'll repay 9 crores.
Yeah, that's it only for the rest of the year.
Okay. I'll take this question offline as well. My second question is, sir, what was the utilization at the Vapi plant?
I don't have exact number of that, but the Vapi plant is running at about 70-75%.
Understood. What was the revenue contribution from Pakhajan in this quarter?
Pakhajan quarter should be, I don't have those breakup, okay. Plant-wise breakup we don't have. But utilization is more than about 55% in Pakhajan, while Vapi is running at about 20% utilization.
So the average selling price per kg in Pakhajan, should I also assume to be around 200 rupees a kilo?
I think so. You can.
Okay. Sir, when you call out your debt to EBITDA by March 26, you want to come below 4. What is the plan going forward in terms of further paying off debt, or maybe the second plan of action when it comes to phase 2 capex? How are we planning that, and by when are we planning that?
Well, for debt to EBITDA, we want to bring it down below 3. So we are confident that by FY27 we will be bringing that somewhere close to that number. We do have some expansion plan. Let's finish this, and then we'll see how much we are going further. And for 27, we'll inform you guys somewhere in our April call what capex we are doing for FY27.
Got it. My last question, sir, if you can maybe just give an idea about how 40% growth in this year. I understand it's largely going to be volume-led itself. Can you call out the difference between how India market is going to be compared to your export markets in terms of growth? And what segments of industries are driving that?
Well, we do see the export will grow further. So we are at 67% and we expect to grow to 70% of our total revenue. The export will contribute 70%. Domestic market is growing but not at that rapid speed. There's a lot of challenges in local market we are facing. Cheap import, we need to fight with that. So yeah, 70% of revenue should come from export going forward.
Any specific segment, because you called out your industrial and auto ancillary is kind of facing a bit of a tough time because of the tariff uncertainty. Which other segments are driving that 40% growth in exports?
Well, we say that there is a challenges, not in entire industrial segment, one of the part of the industrial segment we are facing. Industrial segment, we contribute to the lubricant, rubber, we talk about performance chemicals, we talk about the some of the coating industry. So we work in a wide variety of the, we are serving wide variety of the industries within the industrial segment. And one of the segment is not doing good. So that is somewhat, dragging down our margins mainly, rather than volume, I will say that. The margins are under pressure. And we hope that we should be able to overcome with a different chemistry within our portfolio.
Got it. So we are kind of working also on better product mix within the portfolio.
Absolutely.
Okay. I'll come back in the queue if I have further questions. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Prathamesh Diwar from Tiger Assets. Please go ahead.
Yeah, sir. Just a follow-up on the previous participant question. So as we said, like by FY27, we are planning to be around 3x of debt to EBITDA. And post that, we are also going to announce some capex plans. So, sir, just wanted to know at what range we are expecting our debt to EBITDA should be for, let's say, coming 3 years, 4 years.
Well, debt to EBITDA, I think we will be comfortable in the range of 2.5 times in the long-term vision.
Okay. Got it, sir.
Thank you.
Thank you. The next question is from the line of Ashutosh Nemani from JM Financial. Please go ahead.
Yeah, I have one question. So what is the percentage revenue contribution from auto and auto ancillary segment? If I number, and what is it now in this quarter?
That's only about 25%. 25%.
Sorry?
25%. Yes.
Okay, yeah. And this is majorly Europe geography?
I think across the globe.
Okay, yeah. Thank you.
Thank you.
Thank you. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Thank you so much for taking my question again, sir. I just wanted one small clarification. Like, we are holding a sort of inventory for, so that we can serve our customers faster, but if the prices reduce, so do we suffer any inventory loss, sir?
Well, we have a renegotiation quarter on quarter, or maybe it's with some customers 6 months, some customer quarter. So,
Correct, but
this can only happen during that time, not in between.
not in between, but so just like because our FY25 inventory was on the bit of a higher side, so we had packed up a lot of inventory, and I think we are saying that the prices of our finished goods have dropped. So did we suffer any inventory loss? This
I think so. There will be definitely some inventory loss will be there.
Okay. Could that be quantified, sir?
No, I don't think, we are not done that. If required, just drop an email, we will try to help you with that number.
Okay, it would not be a very significant number.
No, it will be very minor.
Acha, okay. Fair enough, sir. That's it from my side. Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Malhar Sangvi from Bodhi Capital. Please go ahead.
Hello.
Yes, Mr. Malhar, please go ahead.
Your voice is not clear.
Is it better now?
No, too loud.
Just give me a second. Is it better, sir?
Yes. Thank you.
Okay. So my question was primarily on the fact that you mentioned that we're growing by gaining more market share. So I want to understand how much is the probable, the entire market growing at?
I think for an industrial segment, total market share should be in the range of about $15 to $16 billion. And we are trying to gain only about 0.2% of that. We expect to grow to 900 to 1,000 crore in this year. So we are not looking at a very huge market share, very nominal market share.
Right. And how cost competitive are we as compared to China and compared to?
Your voice is cracking again.
So how cost competitive are we as compared to China or compared to EU?
Well, compared to Europe and USA, we are quite competitive. Compared to China, at times we have a challenge in certain segments.
Okay, but you're getting more requests from clients to de-risk from China and coming towards you. Is that correct?
Yes.
Okay, sir. I think that's it from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Anup Agarwal from Lucky Investments. Please go ahead.
Yeah, thank you for the follow-up. Sir, so Vapi is about 12,500 metric ton capacity, and Pakhajan is 20,000. With the 75 crores of capex that you looked at, how much capacity addition will happen in Pakhajan?
I have no idea about that, Anup. Capacity-wise, we are not going to be disclosed, but this 75 crores should add a revenue of about 200 crore plus.
Okay. Are these products at a far higher ASP compared to today, or what?
Same level.
Same level. Okay.
Yes.
Okay, understood. What sort of interactions or dialogues are you having with potential customers outside of India?
I didn't get you. What do you mean by that?
I mean, in terms of the new products that we are trying to make in Pakhajan, what sort of engagements, inquiries are coming in from?
What we are putting CapEx already, we are making it. We see the certain, as we informed you earlier, that we have about 7 products in Pakhajan. Out of that 2 products, we already see the good utilization, and we try to increase that. So that 2 products, we are increasing the capacity. So we don't need an additional approval. It's an existing product.
Okay. And for the other 5, sir, what is other 5 we need approval?
No, they are running product. But that has not achieved the full capacity utilization. So once they achieve, we will see that where to expand.
All 7 products are approved?
Yes.
Okay. By which quarter, sir, are we looking to hit that 70-80% utilization?
I think by quarter 4 FY26, we should achieve that utilization.
Exit quarter 4, 80%?
Yes.
Okay. Okay. That's it from my side. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Fruti Vora from SAS Capital. Please go ahead.
Thank you for the opportunity. So you mentioned that 30 crore has already been incurred out of the planned 100 crore annual capex for FY26. So could you elaborate on which specific facilities this investment is being directed towards?
Well, this has been directed at the Pakhajan facility. Partly money has been spent on an R&D facility and partly for machinery advances we have paid.
Okay. And additionally, could you share how this capex is being sourced? It would be helpful to understand how this investment align with your growth strategy, particularly in terms of product innovation and market expansion.
Well, the R&D will help us to improvise our existing process wherever we require, minimizing the waste. And third, we are working on a lot of new chemistry where we can introduce new chemistry into the industrial segment. So the R&D work on a 2-3 strategy, 1 on an existing process product and 2 for short-term and the long-term projects.
And what kind of financial returns or operational efficiency you expect to generate from this spend over the next few years?
Well, we are looking between 3 to 4 times, which we were enjoying before 24.
Okay. And I have another question, that is, like you mentioned that the Pakhajan facility operated at over 50% utilization during the quarter, and the efforts are underway to ramp it up further. So, could you share more about the next phase of expansion plan for this site?
Already I said that we are expanding some capacity in Pakhajan by investing rupees 75 crores in FY26. And that will translate into the revenue in FY27.
Okay. And additionally, what will be the scale of this expansion in terms of added capacity of product lines, and what kind of capital expenditure is planned for it?
For 27, we don't have plan yet. We have something on a drawing board. We will come back to you only in the April 26, what about the 26-27 capex plan.
Okay. Thank you so much.
Thank you.
Thank you. The next question is from the line of Preeti Agarwal from SK Associates. Please go ahead.
Yeah, thank you for the opportunity. So you spoke about optimizing raw material inventory as part of your working capital strategy. So could you elaborate on your current sourcing model of raw materials?
Well, of our total inventory, almost 60% is import and rest is domestic. We are working a lot of local sourcing where we can buy material locally. We are developing. Those chemistries are not yet been produced in the country. We have identified at least 2 or 3 suppliers where we can source from them if they can produce for us. That will help us because when you are having a lot of imported material, you need to carry large inventory due to the logistic challenges. Even today, we are facing that challenges. So that's a major thing. What we want to what we want to do it.
Okay. And how much of your raw material requirement is met through imports, and what percentage is dependent on China?
Well, of total import, China is about 20-25% only, and this comes from the rest of the world.
And given the ongoing global supply chain uncertainties and global tensions, how are you mitigating risk associated with import dependency, especially from single geography?
As I said, we don't have very few products have come from single geography. Majority of product has a multiple source, either from Asia, Europe, North America or South America. So we have multiple channel partner from where we can source the product.
Okay. All right. Thank you so much, sir.
Thank you.
Thank you. That was the last question for the day. I would now like to hand the conference over to the management for closing comments.
Thank you once again. I would like to thank everyone for taking out time and joining us on today's conference call. I hope we have been able to respond to your queries adequately. Your continued interest and feedback plays a vital role in our journey forward. Should you have any further questions, please feel free to reach out to our investor relation partner. Thank you once again for joining the call today. Good day.
On behalf of Yasho Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.